Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Connie Hill. She's going to be there to help answer your questions along the way. We're glad to have you here, whether you're here in the live version or the recorded version. We're glad to have you with us. Be a part of the conversation, chat in your questions along the way. If you're watching in the recorded version, leave us a comment in the comments section. We'll respond to that as quickly as we can. A couple of quick housekeeping items as we get started here today. We're going to talk a little bit about some of the trades that we've been talking about. We'll also discuss there's a little bit of a pullback in the market today and see what impact that has had on a couple of our trades. So housekeeping really quickly, simply remember that everything that we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice. Remember that investing involves risk, including loss of principal. When we talk about equity and index options, they carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, the options that we're going to be looking at, because they are index options, they are cash-settled options, the ones that we're specifically going to be focusing on are those that are considered to be European-style options. That means that they simply cannot be exercised prior to expiration. The other version, American-style options, can be exercised at any time up to and including expiration. So American-style options, if you are short an American-style option as a trader, you could be assigned at any time up to expiration, regardless of whether it is in the money, at the money, out of the money. Doesn't matter. The Thinkorswim desktop software platform, specifically the paper money version that we use, while not a guarantee of future success, doesn't do certain things like facilitate the early assignment of short options. One of the reasons why we talk about trading index options is to remove some of that early assignment risk out of the discussion. Now, liquidity is always a concern when we talk about trading options at or near expiration on a short-term basis, or really anytime we talk about trading options. Liquidity has to be taken into account. And when we're talking about getting close to expiration, 1 day to go, 0 days to go until expiration, you have to consider the risks specific to that strategy, including that lack of liquidity, significant price slippage, volatility increases, gamma risk, all of those things. We'll talk about those as we get into those discussions. Also, remember, when we talk about using stop orders, and we don't use those a lot in this discussion, remember that stop order is not a guarantee of the execution price, just the trigger price, or the price at which that order becomes a working order. And in the event of something like a stop limit order, that order could not get, there's the possibility that order would not be filled. We're going to use technical analysis in this discussion. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. So let's do this. Let's pop over here to the Thinkorswim desktop software platform. Connie's got the chat going on, and I appreciate that. It looks like our regular suspects are here, so that's good. Good to have you with us today. Take a look at the S&P 500 here today on, again, market data on the beginning of the earnings season as we start to get into some of those financials, geopolitical instability, news, all of those things are kind of weighing, at least initially, on this market. And we can kind of see a very similar pattern to what we've been seeing. I mean, I don't think this is anything out of the ordinary, out of the usual. Is this 1, 2, 3, 4, 5 or so day up, and then a little bit of a pullback into a support level. Seems funny, though, that it oftentimes does correspond with like every other Wednesday that we start to see this little bit of a pullback, but that's okay. Nothing wrong with that. But here's our 50-period moving average. In this particular case, the index not down, on that 50-period moving average, but it is close. It is not as close as it was before. It did not break it as it did the time before that. So there's still potential for this to bounce, to move back up to the upside. 200-period moving average still moving higher. 50-period moving average still moving higher on the SPX. NASDAQ looking a little bit different. NASDAQ right down on the 50-period moving average in this case. but doing just kind of the same thing. It's a little bit of a gap here to the downside. And I'll tell you what, this is an interesting question. And I'm just curious because this question came up over the weekend at our live event in Dallas. Some of you were there, and I appreciate you being there. But one of the questions that was asked was, well, wait a second, do gaps always have to fill? So if a price is moving up and it gaps up, say, for instance, on an earnings announcement, we don't typically tend to see a lot of really big gaps in index products because they tend to be insulated from that gapping movement that is generated generally by individual names that we might see in an individual stock. But it's interesting to me how many people ask the question about gaps always getting filled to the downside, but they never think about the idea that gaps might get filled going back up to the upside, right? So we look at this and we say, all right, well, there's a gap here to the downside. Could it just be as equally likely that price gets sucked back up into that gap to the upside? I'm not a big believer in gaps having to be filled because there's nothing magical or mystical about a price gap like that. All right, that being said, price sitting back down on that 100 or that 50 period moving average, RSI kind of rolling over a little bit and kind of getting into that name here. And then we start to see the Russell 2000, the small caps, bouncing and moving a little bit higher here. They've been on a tear. I mean, an absolute tear in the last little while. Up and up and up and a little bit of flag pullback and up and up and up and a little bit of flag pullback and now up again today. Now, not necessarily closing above yet that low day move yesterday, but starting to move higher here. So Tatiana asks a question. I'm guessing Tatiana. Yeah, Tatiana. Okay. Asks a question. How does assignment work on an index option, and what does exercise look? Well, one of the things about the options that we have been trading is the fact that these are all European style. There are American style index options that allow for assignment. So if I am long an option, remember, I have the right to do something. Taking that right or converting that right into, if it were an equity, a long position in stock or short position in stock, but in an index option, it would be cash or not. Converting that right into something is the process of exercising the right. A European style option does not allow for that to occur until the option has reached its expiration date. What that means is there is no risk of early assignment in a European style option, meaning if the price of the option is in the money, it's out of the money, it's at the money, prior to expiration, it cannot be assigned early. So that is something that is, for many traders, an advantage. Now, if you want to learn a little bit more about those types of options, I want to give you a really quick resource. Now, this resource comes from a third-party provider. This is Cboe Global. This is the former Chicago Board of Options Exchange. That's what Cboe stands for. They've shortened the name to Cboe Global. But if you want to learn a little bit more about index options, you can go here, cboe.com, and then go down through their list of index options and the benefits and the contract sizes. Some of these things that we don't really talk about. We're not tax advisors. We don't even play them on TV, so we can't talk about some of the potential tax benefits or not of index options, but they can. They're the issuers of those products. So it's a good idea to maybe check this out. But remember, this is a third-party provider of information. This is information not coming from us as Charles Schwab. So it is their own information and their own opinions. So just keep that in mind. But I wanted to give you that additional resource to be able to do that and kind of get that information about those index options. So let's jump back over here and take a look at what's going on. And I'm glad that you asked that question in terms of, Tatiana, in the assignment idea and that assignment process. It is one of the reasons why these index options allow for some of the strategies that they do. So let's do this. The one other area that I wanted to look at really quickly here before we get too far away, is what's going on with the VIX, the volatility index, because we had a VIX trade on. In fact, we still do have a VIX trade on. We still have a Russell 2000 trade on. And we're going to talk about these two trades. And the idea being that volatility, this is the volatility index. And again, this also comes from the CBOE, the Chicago Board of Options Exchange. But this represents the volatility of the market, the SPX. And this is an optionable product. And so as we look at this, we get this little bit of a gap up, and the VIX was a little bit higher today. In fact, it was up into the 17 handle earlier. It has come back off a little bit as the market has started to bounce up a little bit. And I'm not going to look at the Dow 2-year moving average. All right, so now taking a look at this move to the upside in volatility, that suggests that volatility is expanding. For options and option spreads where we are short, generally, that is something that is working against us. When implied volatility rises overall, that's generally working against our positions. So we're going to talk about the impact that this little bit of a rise in volatility has had on some of the trades, specifically the SPX trade that we've got on. We'll talk about that in just a sec. But I also wanted to point out, and Connie will post this up at the top of the chat, there is a feedback survey in today's webcast. So your opportunity to help us out and make these webcasts better. A couple of quick questions, and then a fillable form field there that you can put in comments, and we read every single one of the comments. So I appreciate you taking the time to do that. Just click on that link, and you can open it up and set it aside and fill it out later, or you can fill it out right now, or you can fill it out at the end of the class. The risk you run at the end of the class is once the class expires, you no longer have the opportunity to fill out that survey. Kind of like an expiring option. All right, so now we know that the volatility of the index is rising a little bit, of the S&P 500 is up just a little bit, not huge, but it has been going up. Let's pop over here to our monitor tab and let's take a look at a couple of the trades that we currently have in this discussion. So we've got a bunch of things that we want to take a look at here. And I'm going to bring all of those closed. We're going to look at our two areas here. So I've got two trades going on. 3 trades, actually, but I want to talk about 2 of them first of all. And the first one that I want to talk about is this one. This is the VIX option. What ultimately we started as a diagonal spread on the VIX, which means that our long option to start with was further dated than our short option. So we bought a long call on the VIX at the 15 strike. We sold a call at the 17 strike, and we sold that with a shorter period of time. And if you remember from last week, we rolled from one week to the next. So now we've rolled that 17 short call into the same expiration, the 21 Jan expiration, as our long option. So this now has rolled from being a diagonal spread, long the longer dated option, short. Now, when we say long and short, remember long means being a buyer of something, and short means being a seller of something to begin the transaction. So we're long the call, and then we're also short a call. Now what we've done is we've rolled that short call into the same expiration month. So we've rolled it from a diagonal into a vertical spread. And same thing, John. Yeah, absolutely. We talked a little bit about that. That's good. All right. So now here we are. We are long a call vertical spread, which is bullish. We expect that the VIX is going to go up. Ideally, to get maximum theoretical gain on this trade, the VIX would be at 17 or higher. But what we also notice is this flag, because we're under a week to go until expiration, this little flag kicks on that says this is in the money. So our long option, the one that we bought, is in the money, and it has gained value. It's gained about 50 cents in value. The short option, though, on the other hand, and this is kind of the interesting kind of weird scenario here is that volatility has increased, and volatility has increased on the short leg here as well. And now this has started to go back up a little bit as well because the VIX has risen. But if we think about how we might exit this position, we've already brought in a little bit of credit because remember, we rolled this for a credit to begin with. So our net cost was about $1.08 when we first put this trade on. And then what we've done is we've now we've rolled that. So we brought in a little bit of credit. So we kind of bought down the cost of that position. And now if we were going to close this down, we could right click and create a closing order, and we could sell this vertical spread right now for $1.30. Now remember, this is a $2 wide or a 2-point wide vertical spread, 15 to 17. The most that this vertical spread could trade at, the most that we could sell this for would be the $2 width of the spread. We can sell it right now because there's still a little bit of extrinsic or time value here. We could sell that right now for $1.30. And remember, we already brought in some credit in the roll. So we paid about $1.08 for the trade to begin with. We could sell it for $1.30. We're getting some gain on the trade, plus the credit that we brought in. If I remember correctly, it was about 24 or 25 cents. So we're at about 50 cents gain on this trade. It was not a costly trade to begin with. So we've made about 50, maybe 60% on this particular trade. I'm going to go ahead and close this down because now we're getting down into that time frame where we're running right up to the possibility that volatility could rise a lot, but volatility could also go down. So I'm going to right click and on the VIX, and I'm going to create a closing order, which is to sell that vertical spread for $1.30. It's now rolled as a vertical spread. So we're now in this vertical spread, and we're going to go ahead and we're going to try to sell this. I'm going to work that to try to get $1.30 for it. We're going to click on confirm and send, read through that order, and we're going to put this back in our index options group. And again, remember, we want to make sure that this says to close because we're closing down this position. And we're going to click on send, and we're going to fire this order off, and we're going to see if we can get that and we got it for $1.30, which is great. I'm good with that. I'm getting some profit. A diagonal spread, a long call vertical spread, long put vertical spread. Oftentimes, we're probably not going to get maximum theoretical gain. So, Sai is asking this question. How is it that we can see this as, say, for instance, an iron condor? And I'm going to show you really quickly. So what you're going to do is you're going to come up here to your position statement, and you're going to go over to the right-hand side of the position statement to that action menu, and you're going to click on that action menu, and you're going to arrange positions by order. And when you arrange them by order, so watch, I'll show you the difference. So if I go instrument, if I arrange them just by instrument, and I show you, then all I'm seeing is put, call, or whatever order they might be in. I'm not just seeing them as that order. It's whatever order I entered the legs on the trade. But if I come back over here and I do this, arrange positions by order, then it's going to change that to an iron condor because the system recognizes it as an iron condor arrangement. So let's talk about this iron condor for just a second in light of the Russell 2000. So let's go back to the chart for just a moment. Let's go to our single grid, and let's put on here our single grid, and we will look at RUT, Russell 2000. This is the Russell 2000 index. Okay, you can see where the Russell 2000 is right now. It's currently sitting at 2646. It's got a little bit of a support level here that it has established right around the 2600 level. And it's got a little bit of a resistance level right up here at about 2647. So it's kind of banged its head on that potential resistance came from yesterday. So watch what's going on here in terms of our trade. Those are kind of the navigational buoys from the standpoint of support and resistance levels. So let's go back to our monitor tab and let's take a look at our trade. So we know that in an iron condor trade, when we're in an iron condor trade, we want to be inside the two short strikes. If it is a short iron condor, meaning we sold that iron condor to begin with, and we sold this iron condor for $6.45 to begin with, net credit. We want to be able to buy it back for less than that. And right now it's trading at more than what we sold it for. Not a good deal at the moment. Not a good situation because, one, there's still 23 days to go until expiration. So there's still a lot of time value there that has not decayed away. Number two, the price of the index has moved towards one side or the other. It's moved towards and through our call strike. Our call strike, our short call strike is at the 2600 level. Our long call strike is at 2610. So let's go back to the chart. So 2600 is where we wanted that stock, where we wanted this index to stay below. And in fact, it is blown through. And we are short, or excuse me, we're short this one, the 2600, and we are long the 2610. So in fact, this is blown entirely through that side of our iron condor. Now, for those of you who traded iron condors and individual stocks, you know that this is a circumstance where there's the potential to be assigned early on the side that's being threatened. The fact that this is blown through that vertical spread on that side of the iron condor means that that side's very much threatened. And if we were in an individual stock, we'd be worried that we were going to be assigned early on that side of the trade. Now, what that also means, though, is that the put spread, which in this particular case, we go back to the monitor tab and we say, look, where's our short strike on this put spread? It's at 2480. Long side is at 2470. So let's go back to the chart. 2480, holy cow, is way the heck down here, right? Off of this support level. So we are short this one, the 2480, and we're long the 2470. Right? We're long this one. So that right there is our put side or downside vertical spread. I'm just going to drop that in there so that you can see it. That's our downside vertical spread. You see how far out of the money now that is? Our expectation was that the price was going to stay, let me grab my magic marker when we put this trade on, that the price was going to stay roughly in this range right there, and it didn't. It, in fact, went strongly bullish. In fact, we were looking at this level of resistance when we put this trade on, this iron condor trade on, and it just went boom, 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 up through that level and didn't look back. So that can happen. We know that. So what do we do? So this becomes the challenge and also potentially the blessing of an iron condor trade, in that essentially we can manage this trade as two separate short, or in this case, two separate short verticals. Because right now, we're basically at max theoretical loss on the call spread, SCV, that short call vertical spread is just about at that maximum theoretical loss position. This one, way down here, the short put vertical, is probably pretty close to, although again, remember, we're still 23 days out from expiration, probably pretty close to max theoretical gain. Okay, cool. So what do we do? Well, now, I will tell you this. Connie Hill has taught a bunch of webcasts talking about how do you manage one side or the other of an iron condor trade. And so those are out there, and I'll show you where to find those here in just a minute. But one of the things that we could consider doing is rolling out for duration or distance that short call vertical spread and closing down this short put vertical spread. Because if we just close it down right now, we're now taking whatever gain that we've made on that short side, on the short put side, on the downside, and we're not exacerbating the problem. Because there's the possibility, right, that and probably more so in an individual stock than in an index, that we could see the index take a move to the downside and blow back down through that level. So that's why I'm not just going to leave it sitting there, because I don't want to take that risk. I want to take that risk off. I want to redeploy that risk potential someplace else. So now that we have that in mind, we can look at managing this trade. Now, one other thing that we might think about doing would be to do this. Take this short put vertical and just take that whole thing and move it out and up, right? Out and up. So move it up a few strikes so that we're able to collect a little bit of premium by moving it up. And now it's that short side or on the downside move, but it's closer to where the price of this index has moved to. So we could do that. And by doing that, we're potentially helping to finance maybe some of the loss that we've taken in that long side or the call side vertical spread, maybe allows us to continue to move this down the road a little bit. So the problem is, if we do that, we're now putting that short put vertical spread closer to the price of the index, and we could see this make a move to the downside. That is the risk, but that was always the risk, wasn't it? So let's see if we could do that. Let's see if we can roll out and up on the short put vertical and out, because I still think this is likely to be a resistance level in the short term, out, just for duration. Now, you could roll it into a butterfly spread. Yeah, you could roll that right back up to that short leg and make that an iron butterfly. And then you got to get out your JBL speakers and your TAC turntable and your amplifier and crank that sucker up and play some iron butterfly. Okay, now you could, absolutely, Si, you could close out the put side completely. Like I said, we could close that sucker down completely and not worry about it. But if we roll it out and up a little bit, we're going to bring in a little bit more premium, especially if implied volatility has gone up. So if implied volatility has gone up, i.e. the VIX has gone up, and that VIX extends, to the market as a whole, is general idea that all of those options are likely to be getting more expensive. That's very likely the fact that we could bring in a little bit of credit that's going to offset some of that potential loss that we took on the long side, on the short call side. So that's something that we can do. Let's see if that plays itself out here as potentially the case. I will tell you this, my hair right now is probably not long enough to listen to some iron butterfly, but I will tell you who has the hair and who has had the hair in her past. Connie Hill, your gracious chat host, she's got some big hair, or had some big hair in her past. She was, I think maybe in a hairband for a while. So, all right, I'm just teasing Connie. Connie is great. All right, let's do this. Let's go out to the trade tab and let's see what we can do with this trade, or the monitor tab, and see what we can do with this trade. My wife is laughing at me, telling me not to tease Connie because Connie is wonderful. All right, I'm not going to tease Connie very much. So let's do this first. Let's manage the side that's being threatened first of all. So we're going to manage our call vertical spread. So what I'm going to do is I'm going to right click here and I'm going to create a closing position. And this position dissector gives me that opportunity to break this trade down into its subcomponents. The subcomponents are two vertical spreads. The subcomponents are the individual legs of those vertical spreads. So we're going to deal with the call vertical spread first. And so what I want to do is I want to roll that long or that short call vertical spread, the top side of this particular trade. Connie is much more practical these days. All right. So here's what I'm going to do. I'm going to create a rolling order. So we're going to roll that call vertical spread, and we're going to roll it out for time. Now, by default, when we create a rolling order, the Thinkorswim platform, I don't want to roll the whole iron condor. I want to roll just the call vertical. So we're going to go back there. I'm going to right click and we're going to create a rolling order. And I'm going to sell the vertical roll on the call side. So we're going to sell that vertical roll. And by default, like I said, by default, the Thinkorswim platform looks at the next available expiration. So this is going to roll it out to the 13th of February. That doesn't give us a huge amount of time, but it does give us some duration for this to make that move back down to the downside. I'm going to give it a little bit more time here. So I'm going to change that duration. We're going to go out to, say, for instance, the 20 February expiration. And I can actually do this roll for a little bit of a credit by doing it that way, bringing in a little bit of a credit. A minus 20-cent debit is, in fact, a 20-cent credit in this particular case. Now, rolling's not a magic wand. It doesn't eliminate any transaction costs or anything like that. It doesn't really give us a pricing advantage, and it depends on the liquidity of the target. So if there's not a lot of liquidity there, that's going to be a challenge to get this roll to happen. But I'm happy rolling this out for a 45-cent debit and letting this continue to do what it's going to do. What hurts us is if we roll this and it continues to move on up and away. So if it does, then we'll deal with it at that point. So I'm going to roll the top side first. Click on that order. Make sure that that's what we want it to do. Make sure that we're aware of the characteristics here. And I'm going to go ahead and I'm going to send this order off, and I'm going to fire that off. And we're going to roll that out. And we got that roll. So now we are short the call vertical spread out to the 20 February expiration. So we've pushed that down the road a little bit. Now we're going to roll out and up our short put vertical spread. So we're going to go back to the monitor tab, and we're going to come right down here, and I'm going to right click, and we're going to create a rolling order. So we're going to sell a vertical roll. Whoops, let's go back to this. Let's go back to our iron condor. We're going to create a rolling order, and we're going to roll our put vertical spread. So we're going to sell this vertical on the put side. Now, I want to align, in this case, I want to kind of roll back into the same expiration time frame. So I'm going to roll this one out to the 20 Feb expiration. And I want to roll it up some strikes. So I'm short the 2480. I want to roll this up a little bit. So I'm short the 2480. So now what I want to do is I want to roll. This is the one that we're going to go to. It's the 20 Feb expiration. So this, guys, this is where you have to be, you have to pay attention to the details here, because you want to make sure that you know which one you are closing and which one you are opening. We're closing the shorter dated one. We're opening the longer dated one. So I want to roll this from the 2480 strike, not straight out to the 2480 strike, but I want to roll that up a little bit to, say, for instance, the 2500 strike. And I want to roll this one, the one that I'm long, not to the 2470, but I want to go to the 2490 so that I keep it 10 points wide. So now I've rolled from the 2480 to the 2500 and from the 2470 to the 2900. Those two strikes. Now I'm still in alignment. I've just moved my entire vertical spread, this side of the iron condor, up and out in time. So we're back in alignment. It's a narrower vertical spread, or excuse me, it's a narrower iron condor. So it's got less room for movement in the price of the index. But look at the credit I'm bringing in. So I brought in a 50-cent credit on the other one. I'm bringing in a 50-cent credit here in addition to the $6 credit that I brought in to begin with on the trade. So I've just added another $1. I'm just adding another $1 to the credit that I brought in on this trade. So I kicked it down the road, even though it moved away from me, and I've just adjusted this whole vertical spread up. So I'm going to go ahead and I'm going to click on confirm and send, read through the order, make sure that that's what I want it to do, and click on send. We'll see if we get that roll. And if we don't, we might not. We might have to wait a little bit. We might even have to bump that just a little bit to see if we can get it, because I was talking while that was moving. Let's see if we can get that to fill. Let's go to the working order section here, and I'm going to right click and cancel, replace the order. I'm going to bump that open a little bit. I'm going to bring that down just a little bit in terms of my limit price. And I'm going to click on confirm and send, and we're going to make sure that we put this back in our index options group. And I'm going to click on send, and I'm going to fire that order off, and we can get it. So we got it actually by bumping it a little bit and kind of getting it off of there. We got it for about 75 cents. So we actually got a little bit better credit in this particular case. So that's how we would go about managing this particular trade. So now we go back to our monitor tab, and here's what we've got. Now, this is going to show custom because we kind of adjusted this one leg at a time. So now it's kind of broken it apart. So you just have to remember now that this is still an iron condor. We are short the 2,500. We are short the 2,600. So we got $100 or 100 point wide range in which we want this trade to move. So now if we go back over here to the Analyze tab and we look at Russell 2000, we put this over profile graph, and let's see what we've got down here. Now we might have to squish this in a little bit and take a look, but there is our iron condor and the range. Let's see if we can move this down so you can see these a little bit better. There you go. There's the range that we want this to move in. Click on set slices to break evens out here at, we got to bump that out. We know that that expiration is further out. And there's our break even, 24.82 and 25.98. Those are our break evens kind of right there at that range. So we know where that expiration is and where that expectation is for this particular trade. So that's what we've done is adjust. Oh, I got a bunch of other junk in there. Let me take that stuff off. And I want to just show, let's take that one out and that one out and that one out and that one out and that one out. There we go. So now there's our current iron condor trade. Let me do that again. Set slices to break even. There it is right there, 24.91 and 26.10 on the upside. So that's our break even range. We actually made those break even ranges a little bit better because we brought in a little bit more credit. So we've got a narrower range in which we could take a max theoretical loss in the trade. And even though we've got a narrower range in which we get max theoretical gain, the original iron condor was at 2,600, and it was right here. It's this one right here. 2,600, 2610, 2480, 2470. That was the original iron condor. 2470, 2480 on the put side, 2600, 2610 on the call side. That was the original one, Harry. The one that we rolled it to is 2490, 2500, and 2600, 2610. So we rolled out the call vertical same strikes. We just bumped up the put vertical spread and adjusted that up to the upside. So that's how you go about doing that. It takes a little bit to process it, but that's sometimes something that we can do. All right. Wow. Holy cow. Time. All right. Let's go over here to the monitor tab. Let's take a look at a couple of other things. Our volatility spread we talked about. Let's take a look at our short put vertical spread on the SPX. This is our 14.7. Let's see if we can do this in about 4 minutes. So we sold it for $1.70 to begin with last week. It is now trading at 90 cents. It was trading at $1.75 earlier this morning when the market was down hard. It's come in a little bit, which is good. So what we're going to do is we're going to close this one down. So I'm going to create a closing order to buy back that vertical spread and take that off. And this is what we do every week, 14 to 7. 14 days to go until expiration, we put them on. 7 days to go until expiration, we take it off. So we took that one off. We got a little bit of gain on the trade. We got about 80 cents of gain in the trade, which we know that we're typically not going to get max theoretical gain in these trades, but that is the nature of this particular trade. So now what we're going to do is we're going to go out to the 28 Jan expiration. That's going to be our next target date. So I'm going to change my grid really quickly to my index options grid. And we're going to move our time frame out. So we said that our time frame was, for those of you that are just brand new to this, we've got numbers of webcasts of this where we talk about the basics of this particular strategy. I'll talk through it along the way. We're going to go out to the 28 January expiration. So I'm going to take this time hack and I'm going to activate it, and I'm going to move it out to the 28th of January. So that there it is right there, 28th of January. 28th of January, and I'm going to set that in place. There it is, and click OK. Now I'm going to take my line tool, and I'm going to draw my line at the cross of the probability of expiring cone and that time frame. So that's at 67. I'm going to go 67.30. It's right at 67.30, which is in fact where we were on the last one. So right about the same. What's happened is implied volatility has risen, even though the market's moved up and then pulled back a little bit. This purple line is that probability of expiring cone. So we're going to look at selling the 27 or 67.30 strike on the put strike. We're still moving higher, even though this is giving us a little bit of a down day today, but that's coming in as a big red hammer right now. So we're going to go to the trade tab. We're going to go out to 14 days to go until expiration. I'm going to go out probably 150 strikes is what I'm going to need. Maybe not that much. 120 strikes. Let's see if that gets us there. And we know that our short strike is going to be 67.30. So let's go to the 67.30. Do we have a 67.30 this far out? 66, 67.20, 67.30. There it is. If I change the layout to Delta, Theta, and Vega, that 67.30 is about the 16-cent delta, which is about where this has been falling. So we're going to sell the 67.30, and we're going to keep it 20 points wide. So that's going to be the 67.10. So we're going to sell this for about 205. Remember, implied volatility last week was a little bit lower. Now we're able to get a little bit more at this strike. Same strikes, we're actually getting a little bit more credit because implied volatility is a little bit higher. That worked against us in getting out of the previous trade. It's working for us in getting into this one. So now, max theoretical gain in the trade, $200. Max theoretical loss, $1,800. It's a 20-point wide vertical spread. We're going to put this in our index options group, in our weekly group. We know that this is our weekly rotation. Sell it at 14 days to go until expiration. Buy it back at 7, come what may. So we're going to go ahead and click on send. We're going to fire that order off, and we got it for 210. Now it's out there. We're going to roll it back into this next week and see what this has done. The expectation is if the index keeps moving higher, if implied volatility goes down, if time continues to pass, then that's what is benefiting this consistency trade. Jeff asks the question, what's this study? Probability of expiring cone. Probability of expiring cone. And if this starts to move to the downside, well, that means that volatility is going up and we're likely to offset that closer range with higher implied volatility, which is going to move us out a little bit more because that's going to change this probability of expiring cone. All right, guys, great stuff today. Here's where you're going to find more information. We're going to pop over here and go to the Trader Talks webcast page. One simple ask, guys, click on that subscribe button if you haven't done that already. And this is where you can search for that 14.7 for more information about managing iron condors, for index options, for all the great stuff that's out there. Remember to fill out that feedback survey. Remember to follow us on social media. I'm at Ben Watson CS. Connie is at Connie Hill CS. Thanks for joining us. We'll look forward to seeing you back here next Wednesday. I think Scott Thompson's coming up next with his Getting Started with Stock Investing webcast. Have a great day, everybody. Take care. Bye-bye.